We're taking a look at stocks higher today as investors await the latest Fed decision on Wednesday. Investors are no longer anticipating a rate cut at this March meeting. So with that out of sight, what should they be focused on? We're joined by Lynch, Scharf Investments Managing Director. Thank you for joining us this morning. So as we look at what some of the investors have been really mulling this week, we know obviously the AI push, keeping some of the rally elevated here, but also the Fed as well. If a rate cut is off the table here, what should we be focusing on at this meeting?
Yeah, I think a rate cut's clearly off the table, Rochelle, because you've got really these strong CPI, PPI prints, persistent strong job growth. Yes, things are slowing a bit in the economy, but it's still strong, and so there's really no reason for a rate cut this week. Arguably, even next week, markets are really not pricing in the first rate cut in terms of the highest probability until June. So I think what investors need to be looking at is what's the speed of these rate cuts going forward, and what's the timing. It looks like, heading into this FOMC meeting, you had 3 cuts on the dot plot. We may see that decrease to 2. But I would argue that at this point we're kind of splitting hairs.
Yeah, I mean, we've had analysts on who've sort of said, just timing of this doesn't necessarily matter. It is about, to your point, what that cycle looks like. I mean, are we expecting, or are you expecting any significant move on the markets, on the back of this meeting, just based on what Powell's likely to say? If we sort of get, what has been pretty much a consistent message from the Fed chair, seems like most of that's already been priced in.
Yeah, I think that's right, Akiko. It's what's interesting. If you look at what's happening in the markets, at least the equity markets, you've seen a pretty strong rotation from the Mag 7, the technology U.S. mega caps, into just all sorts of different areas: cyclicals, financials, international, small caps. And so what I think that is telling you, what investors are trying to tell us, are that we need to probably pivot our attention from the macro to the micro, start looking at earnings going forward. Because if you think about it, what's really driven the stock market in 2023, the S&P 500 was up 26%, profits were flat. And so now you take off immediate and substantial rate cuts off the table, then the eyes or the focus is going to be more on the economy and on earnings growth going forward. And I think that's what we need to start focusing on in these guidance going forward for 2024.
So then, Eric, what would be some of the bellwethers that you look at when you're looking at the micro story that we got out of those Q4 earnings?
Yeah, great question. It looks like earnings have improved, so that's good. Even though they were flat for calendar 23, Rochelle, they were growing 3.4% year over year as we ended the year, guiding for something similar for Q1. I think what we need to see is just broad-based margin improvement. Margins really contracted hard. If inflation's coming down, maybe you see some margin improvement in the consumer staples, things like that. Hopefully we get some service wage pressure off, and the service companies get better margin improvement. But those are things to be looking for. And I think if the economy stays kind of on this current 2 to 3% GDP trend, then again, you're talking about a broad-based economic growth, and I think you just want to be looking across a diverse set of stocks in your portfolio, rather than this over-concentration on the big mega cap tech stocks names.
Finally, Eric, we're talking so much about this NVIDIA conference. We got Dan Howley in San Jose today. There's a lot of hope riding on these announcements. I see a big warning in your note that says, be aware of AI mania. What worries you there?
Well, look, I think AI is for real, clearly. The use cases, which we're only beginning to discover now, are going to be pervasive and substantial. That's no doubt. But that's going to take a long time. Major technological innovation change takes a while for the productivity to infiltrate the rest of the economy and be seen in profits across the board. And so because of that time, I think we need to be delineating between first derivative, second, third derivative AI plays. First derivative is clearly NVIDIA providing the GPUs, the hyperscalers renting them out. And those guys, you see it reflected in their profits and their earnings. NVIDIA's year-over-year profit growth for Q4 was an eye-popping 765%. Adobe last Thursday reported investors were expecting this real substantial AI pop. Didn't get it. Growth was really still on par with what it was before the AI introductions into its suite. And so I think what we need to do is just a wait and see attitude on the second derivative stories going forward. But NVIDIA, I don't think there's anything to be worried about in the immediate future of the cloud hyperscalers as well. Clearly, there's way too much demand versus supply, and they're in good shape.
And certainly for the others, still in that
Eric
show
Lynch,
and
Scharf
prove
Investments.
state at the moment. We want to say a big thank you to Eric Lynch there, Scharf Investments Managing Director. Thank you for your time this morning.
Thank you both.